The market is becoming weird. That's how analyst Leo Nellison describes our current environment, where the old economic playbooks simply no longer apply. For decades, we relied on straightforward macro numbers like employment and inflation to predict growth, but today, those relationships are breaking down. If you're still investing based on the 2010s playbook, you might be missing the biggest rotation of our lifetime. Let's dive deep into why Wall Street has to adapt. Historically, higher employment meant more spending power, which fueled economic growth. It was a clear, predictable cycle that investors live by. Lower employment meant reduced spending, which pressured the economy, a doom cycle that everyone wanted to avoid. But right now, that entire relationship is breaking apart. With consumption accounting for more than 67% of US GDP, our economy has always relied on healthy spending from a large workforce. But AI is changing that math. We are entering what Nellison calls a jobless boom. This is a phase where the economy generates massive wealth without the traditional need for more labor. Look at this chart. We're seeing the first major divergence in job demand and economic growth since the early 1990s, and this time it's driven by AI productivity. This is especially worrying for young people just entering the workforce. As the price of knowledge drops, the dynamics between labor and growth are being reset. In prior cycles, higher output required more people. Now, companies can grow by shifting their capital expenditure, or CAPEX, heavily into AI and automation. While office and management roles are being replaced, we're seeing strength in the real economy, areas like farming, construction, and transportation. These physical jobs cannot be replaced by AI as easily. If the thesis of broadening economic growth is right, these sectors are in much higher demand. This leads us to a massive indicator for the rotation from growth to value. Growth companies are the ones spending. Hard asset companies are receiving those flows. This rotation is in its very early innings. Hard asset companies are hiring people to turn those orders into revenue, while tech faces the risks of AI disruption. But AI spending isn't just changing stock charts. It's distorting the physical world, specifically real estate and the cost of energy. Trillions in long-term spending for data centers are distorting the economy. So much money is flowing into real estate that home builders are being priced out. This creates a nightmare for housing affordability. We're already in a crisis, and the demand for land to build server farms is only making it worse. The income needed to afford a median home is now way above the actual median income. Data center demand is a major factor driving land prices higher. Look at Elk Grove Village near Chicago. A data center company purchased and knocked down an entire 55-home subdivision just to build more server space. In Texas, land prices along Route 67 jumped from $20,000 an acre to over $350,000 in just 3 years. Home builders simply can't make those numbers work. This is why investors are getting bullish on companies like LandBridge and Texas Pacific Land. Data center spending will likely shift to areas like West Texas to avoid these costs. The real winners are the companies providing solutions to these bottlenecks. Forced capital spending from AI giants is meeting major physical supply constraints. But there's another secular trend that Nellison believes is even bigger than AI: robotics. We're seeing a move from impractical robots to true physical AI. Robots like the ones from Figure are now working on internal architecture without needing to be hard-coded for every task. They are becoming lifelike and autonomous. AI is causing the price of code to drop towards zero. This is why software companies are struggling, while the physical implementation of AI, robotics, is booming. Robotics has beaten the market significantly this year. We're seeing enablers like Tesla and Amazon deploying millions of robots across their networks. Advanced humanoid robots can now be put to work for roughly $10 to $20 per day. This changes the entire calculus for global manufacturing and labor costs. Amazon already has over 1 million robots operating in its network, and that's likely just a fraction of the long-term potential for physical AI. So, what does this mean for your portfolio? The US has truly become the go-to place for AI, but that success has resulted in very premium valuations. The US market is roughly 40% more expensive than the rest of the world based on forward PE ratios. This creates a risk for rotating capital out of the US if other regions catch up. However, Nellison isn't dismissing the S&P 500. He believes it remains a perfect foundation for long-term wealth, even if future returns are slightly lower. The S&P 500 index eventually captures the AI winners as they rise to have a large share in the index. It's a way to deploy capital without worrying about every single bot. Infrastructure Capital Advisors CEO Jay Hatfield notes that while the short AI thesis was irrational, we are seeing a reality check in earnings. On a year-to-date basis, the equal-weight S&P 500 has outperformed the standard index significantly. This is clear evidence that the rotation is happening. As labor market insecurity grows, it's more crucial than ever to invest. We need to grow along with the technologies that could disrupt our careers. The preference today is for assets at the receiving end of massive AI capex and general value stocks that benefit from broadening economic growth. This includes power companies like Diamondback Energy, infrastructure like Onyoke and Eaton, and cyclical value plays like Union Pacific. He also points to miners like MP Materials and copper giants like Freeport-McMoRan as beneficiaries of the coming industrial renaissance. The strategy is simple. Keep the S&P 500 as your core and build satellites of these bottleneck beneficiaries around it to future-proof your portfolio. This approach can reduce AI risks and allow you to benefit from the very bottlenecks that are slowing down the rest of the market. That's how you generate alpha. The biggest mistake investors can make today is trying to apply the old playbook. We are in an entirely new market environment. AI is no longer just a bullish-only factor. It's splitting the market into winners and losers. You have to dig deeper to find what actually works. Don't be afraid to adjust. Assessing the market through this new lens of physical constraints and AI productivity is the only way to thrive. Stay informed, adapt your strategy to the current physical and digital realities, and prepare your portfolio for the long-term shifts ahead. Adapt, stay informed, and I'll see you in the next deep dive.